There was a time in the early part of the decade of the 90s when optionality was free. Nobody expected the gold or silver price to rise. And so you could buy gold assets in the ground for $5 an ounce, $10 an ounce, understanding that if gold repriced, that those assets would underprice. That worked because nobody was buying gold optionality. People buy gold optionality now. So in order to participate in that game, you're exposed to things like $2 billion market caps, which I don't do. I'm an absolute value guy, not a relative value guy. There are lots of other ways that work for people who are good at them, but that's what works for me. It's what I understand, so it's what I do.
Last week, silver surged past $37 an ounce for the first time in over a decade, reaching levels not seen since the peak of the 2011 bull market. This breakout is reigniting interest across the commodity space, with seasoned investors now wondering if this marks the beginning of a significant revaluation in precious metals. While gold has been steadily climbing and capturing global attention, silver's sharp upward move is turning heads, signaling a powerful momentum shift. According to veteran resource investor Rick Rule, this move marks the early innings of a market that's been ignored for too long. Rule has long emphasized that silver markets are thin and highly reactive, and when capital returns to the sector, moves tend to be swift and disorderly. What makes silver's current breakout particularly compelling is its historical behavior during past precious metals cycles. As Rule often points out, silver has a well-documented habit of lagging behind gold, then outperforming it dramatically once the uptrend is established. The gold-to-silver ratio, still hovering near 90, suggests that silver is significantly undervalued when measured against historical norms, which are closer to 60. In previous cycles, once the ratio began to revert, silver would rocket higher in a fraction of the time it took gold to climb. Rule often references both the 1970s and the 2000s bull markets as textbook examples. Once gold moved, silver followed with volatility that rewards the bold. With gold recently surpassing $3,500 per ounce and silver still below $40, the relative value is glaring. Adjusted for inflation, silver's 1980 peak would now sit closer to $75, and many long-term investors view this not as a stretch target, but as a logical recalibration in an environment of sustained monetary debasement and geopolitical tension. What sets silver apart in the current environment is its dual role as both a monetary asset and an essential industrial metal. Unlike gold, silver's demand is driven not only by investment and store of value considerations, but also by its critical applications in cutting-edge technologies. At the same time, silver supply faces increasing constraints due to mining limitations and environmental regulations, intensifying scarcity. This unique combination of rising demand and tightening supply forms a powerful fundamental underpinning for silver's price outlook. Now, we present the clips from Rick Rule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
People who are technical traders, there are people who are momentum traders, there are people who are sentiment traders. That's not what I am. I'm an investor, and by education, I'm a value investor. So I use the strategy that's worked for me that I'm comfortable employing. Because I'm comfortable employing my strategies, I'm unimpacted by volatility. People that have never developed a strategy or don't follow their strategy tend to be shaken out of their investments during times when they mistake volatility for risk. So I never change what I do. There was a time in the early part of the decade of the 90s when optionality was free. Nobody expected the gold or silver price to rise. And so you could buy gold assets in the ground for $5 an ounce, $10 an ounce, understanding that if gold repriced, that those assets would underprice. That worked because nobody was buying gold optionality. People buy gold optionality now. So in order to participate in that game, you're exposed to things like $2 billion market caps, which I don't do. I'm an absolute value guy, not a relative value guy. There are lots of other ways that work for people who are good at them, but that's what works for me. It's what I understand, so it's what I do. You know, there's a whole bunch of silver dross out there. Little companies whose real exposure to silver is confined to the fact that they have silver on the name of the company and the share certificate. You know, the price of something goes up and you don't have any. It shouldn't matter very much, but I guess sentiment matters. The phenomenon that you describe is extremely important for people to understand. I experienced it personally in the early part of the decade of the 90s, where I was part of the genesis of both Silver Standard and Pan American Silver. Those two companies escalated from our first financings, 50 cents on Pan American and 72 on Silver Standard, to 5 or 6 years later, plus $40 bids. People don't understand the upside in legitimate silver juniors. They're the most volatile asset class in resources that I know of. The caveat is that you have to be involved not merely with narrative, but with high quality people, with Ross Beatty's and Bob Quartermain's, and high quality deposits. There are a few of those out there. I would suggest that Abra is high quality. I would suggest that Vizsla is high quality. I would suggest that Aya is high quality. And there are a couple others knocking on the door. As you suggest, a couple of the small producers, Gatos and Silvercrest, got gobbled up. That's okay. Got paid a nice premium. If you wanted, you could take shares in the acquirer so that in the run-up in silver prices, that deposit will continue to benefit you. But there's a lot to be said for doing the work to establish a five-stock position among the silver juniors and then just relaxing until the generalist investor comes into space. I've never seen a frenzy around anything, with the exception of uranium in 2002, that resembled the silver frenzy, the junior silver frenzy that I experienced in 1992, 1993, 1994, and 1995. It was unlike anything. I was identified as the sort of promoter between Pan American and Silver Standard. And institutional investors would call me up saying, "How are you doing this?" And I would say to them, "Well, that's a trade secret. It's not available." The truth is, I wasn't doing anything. The market went absolutely crazy. What happens in a bull market, for people who were early in the bull market, they bought a narrative before the narrative came true. As the narrative begins to be demonstrated by the price appreciation of the product in hand, that very price appreciation justifies the narrative. But that price appreciation devalues the narrative. In other words, if you think the gold price is going to triple, and then the gold price triples, your narrative is done. Perversely, you believe in it even more because you feel good, particularly if you were tested early in the period. I, as I've told you, Jordan, came into the market in the 1970s, the wildest bull market that resources have ever seen. I had the good fortune to come into it very early. And because I was naive, I played it very aggressively. And as a consequence of playing it aggressively, I outperformed many people who were substantially smarter than I. And I came to believe, perversely, as a young testosterone-driven male, that my performance had to do with my genius, ignoring the fact that the gold price went from $35 to 850, and the oil price went from $2 to $30. And I ignored, too, the fact that markets work, that the cure for high prices, including commodities, is high prices, including commodities, and that the market would correct. And come about 1982, when that commodity bubble burst, I learned just how smart I was, which is to say, not very. The good news is that I have been able to guard against my own hubris ever since. I have been able to say, "Rick, is this getting too easy? You are starting to make money on your mistakes. Do you remember how bad you felt when you went from being a wealthy young man to having a negative net worth?" The answer to that question, by the way, is yes. And I have managed ever since 1982 downdraft, I have remembered to take advantage of the bull markets. I remember once in Midland, Texas, after the crash in oil that occurred in the mid-'80s, seeing a wonderful bumper sticker on a car. Said, "God, one more bull market. I promise not to waste this one." And I remind myself of that, just like I reminded myself a couple of weeks ago that the reason that I had bought added positions in the uranium juniors was because they were going to overcome hate. And for that part of my position, not my whole uranium position, but the part that was bought in anticipation of overcoming the hate, when that goal was met, I had to sell a stock.
The recent surge in gold and silver prices has sparked renewed interest across the entire precious metals sector, highlighting exploration stocks that often serve as early indicators of market momentum. As gold continues to hold strong and silver breaks above key levels not seen in over a decade, investors are increasingly turning their attention to the juniors and explorers that could benefit most from this rally. Rick Rule highlights that tracking when money truly starts flowing into exploration stocks isn't always straightforward, but one clear sign is the rise in project transactions by prospect generators. When these companies report an uptick in farming out projects, it signals that capital is becoming more accessible, and management teams are preparing to capitalize on favorable market conditions. This resurgence in exploration funding has been quietly building over the past couple of years, gaining real traction about 6 months ago as specialist investors, including family offices with sector expertise, began showing heightened interest. Rick Rule points out that while many smaller, weaker juniors still struggle to raise funds, the higher-quality exploration companies are experiencing oversubscribed private placements and strong capital inflows. Major industry players are also stepping in, injecting equity capital into promising juniors to secure future growth and project pipelines. This convergence of rising metal prices, targeted capital inflows, and industry participation marks a pivotal moment for the exploration sector, suggesting the early stages of a new and potentially powerful exploration cycle closely linked to the precious metals rally. Let's get back to the video.
Well, at risk of being self-serving, which of course I am, the Rule Classroom is very good. There's 200 hours of instructional programming there, including 11 hours of real how-to called Introduction to Natural Resource Investing. There's a lot of free sources, there's a lot of paid sources, and a lot of them are good. It's important that you consume those sources you consume sources that communicate to you. There are people out there who, I can't imagine this, Jordan, but they consider me to be an arrogant, smug human being. They probably shouldn't go to the Real Classroom. I am who I am. And if you can't consume the information from me, there are other places to get it. But the point is, do it. I think the important thing, Jordan, that people must do when they come into the sector is they have to do what you did. They have to assess themselves. They have to assess their strengths, their weaknesses, their goals, their timeframes. And then they have to begin the process of systematic education. The sector doesn't change that much. Past is prologue, but you have to do the work to understand what the past was so that you can use it as prologue. You did the work. And newbies to the sector need to ask themselves whether or not they're willing to do the work. Does it interest them? If it doesn't, if they understand the gold narrative and they want to use gold to protect themselves in the future, they should buy some gold and they should buy the best of the gold stocks, the best, and they should get on with their life. If, by contrast, they begin to get absorbed by it, they have competitive instincts or intellectual instincts like your own that suggest that they want to outcompete the beta, that they want to generate alpha, that's very different. Then they need to begin the process of outcompeting other investors. And you do that by having better access to information and a better ability to assess information. Informal tool that I've used for 30 years has been the frequency or infrequency of transactions by prospect generators. When I see prospect generators in their quarterly reports to shareholders showing increases in transactions, which is to say them being able to farm out more projects than they were a year earlier, when I see this across the length and breadth of the 40-something prospect generators that exist, I know that the game is on. I know that the financing window is open. I know that management teams who haven't taken on projects because they prefer to get paid salaries are becoming more aggressive, and that means that money is becoming available. There are probably more efficient indexes than that, but I don't know them. I follow funds by actually follow funds, which is to say, when I see transactions that are being funded by the vendors, then I know money's back in. And by the way, money's back in the space.
So you think money is now starting to come into the exploration stocks?
I know it. The second thing I see is in a very small population of high quality exploration stocks, and this has been true for 2 years, their private placements are overfunded. I'm a fairly well-known investor, and many companies tell me that having me on their register or being able to announce me in a press release is a positive for them. And I find myself, despite this alleged advantage, being cut back in financings. That's not the mark of an underfunded sector. Now, the lame, the halt, and the blind, the dross, which is 85% of the listings, they're still having difficulty raising money because the investors haven't totally taken leave of their senses yet. Most of the sector shouldn't be financed. It should be allowed to return to its intrinsic value, which is zero. But in the better part of the sector, there's a lot of money around. Interestingly, it isn't generalist money yet. When I look at the roster of investors in the better juniors, they're all names I know, or not all names I know, but the majority of the population is names I know. The second thing I'm seeing is in the very small specialist funds, the 50 or $100 million exploration funds. They're all experiencing very strong of capital. I did an interview yesterday with the CEO of Agnico Eagle, and I asked him various things about their growth strategy. And he said part of it is providing equity capital for very high quality juniors. He points out that, as an example, if they go into a new region or a new country, just establishing the office, hiring the people, staffing it, is $1.5 million. If he can buy, 10% or 15% of an established junior with the right to participate in the projects that they generate or whatever, that investment has, in a sense, paid for itself on day one. And you are seeing a lot of participation in the junior space from the industry itself, which is important. You're not seeing it, the kind of stocks I'm referring to, the $5 million market cap where general and administrative expense is 60% of total expenditures. You're not seeing it there, and hopefully you won't. But among the legitimate juniors, money's back in the space.
Silver's recent rise beyond $37 per ounce signals more than just a price movement. It reflects the growing recognition of silver's dual function as both an essential industrial commodity and a valuable monetary asset. This unique combination sets silver apart, as it benefits from increased demand in emerging technologies such as renewable energy, electric vehicles, and advanced electronics, while also serving as a hedge against inflation and currency fluctuations. Although breaking through the $40 mark seems well within reach given current momentum, pushing toward $50 will require persistent strength in demand, supportive monetary policies from central banks, and potential tightening or disruptions in supply. Investors should be aware that factors such as geopolitical shifts, inflation trends, and technological adoption will play a critical role in shaping silver's trajectory. Where do you think silver prices will go next? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.